Good morning and welcome to this week's edition of Winston's Weekly, covering all things property. I'm Manny Anton, your host for today's property chat. Winston, welcome back.
Thank you.
Okay, as usual, let's start with rates and inflation data movements in the US markets. We continue to see a lot of movement in markets, certainly equity markets being pushed around by sentiment on inflation and rates. This week in the US, we saw earlier in the week we saw a couple of bond auctions by the government over there, and they weren't very eagerly received.
No.
So in fact, the result was that yields started to edge higher post those two issues. So we also saw several comments from some of the Fed governors during the week suggesting there was no rush to cut rates. Again, same thematic that we've been seeing the last few weeks. So what are your thoughts on this? What's going on with rates in the US and how it might impact property over there?
Well, as the Fed has said on many occasions, and even the RBA here, everything is data dependent. And the data that's been coming out has not been positive in terms of sort of engineering a rate cut early. CPI numbers have been going the wrong way. So inflation is an area of concern for both the Fed and the RBA. And so there's even talk that there's a growing expectation that in fact the next rate move might be up rather than down, both in the US and in Australia. But we need to just focus on the data as and when it's released. And again, in terms of the Fed and the RBA, they're looking for a consistent downward move rather than a 1 month. So even if we get a better number for a month, they want to see that continuing over a period of time, and we haven't seen that.
Yeah, absolutely. And it looks like the talk now, particularly in the US, is they're pushing back any potential rate cut to September and beyond.
Yeah,
seems to be the talk.
Well, the issue with that is that there is an election over there in November,
Yep.
and I don't think the rate wants to be sort of seen around the election time to be moving rates. So if anything is going to happen, it's going to be, say, in September,
Yeah.
and maybe then December rather than
Yep.
through the interest rate. Through the election period.
Yeah.
So that's one thing to keep in mind. And but it's about the data. The data has to be consistent.
Yeah.
So what we've seen in the US now is the 10-year bond rate is at 4.55. It's broken through that 4.50 barrier. As you said, the auctions didn't go too well. It was priced at the top end of the range in terms of yield. The demand wasn't as great. So, people are expecting in this uncertain time a bit more of a premium in terms of if they're going to be buying bonds.
Yep, that was definitely a message that came through. It's sort of focusing a little bit more on our domestic markets here. We had April CPI data released this week, which you've touched on already, but it came in higher than anticipated at 3.6 versus expectations of around 3.4. Again, as you've also said, inflation here domestically is looking very sticky, and a lot of the commentary has been around the possibility that the next rate move could be up.
Correct.
And if that is the case, how are you seeing this sort of sentiment play out in domestic property?
Well, it's really a situation of it's either a feast or a famine, and at the moment everyone's looking at it from the basis of a glass half empty rather than a glass half full, and so there's people seem to be stepping away. The REIT sector, so far this month being the last day of the month, is up 2.1% for the month, which is not too bad in the environment that we've seen, but it was up 5-6% earlier in the month. So it's been dwindling down as bond rates have been moving up. We have seen maybe a couple more of transactions take place, but again, they're at the lower end of the market. They're not really reflective of the big end of town in terms of what's happening with valuations and where buyers and sellers are willing to meet.
All right. Has Goodman's continue to be the key driver of that index, that property index?
Goodman's continues to be the key driver. It's I've mentioned before, it's seen as the proxy by a lot of the general equity guys as the exposure to property being in Goodman's. The positive aspect they see is that it's involved in data centres now, and that's a positive for the sector overall. Goodman's has been up and down, but not to the same extent that the rest of the market has. In fact, Goodman's probably helped the market to make that 2.1%.
Yeah. To remain in positive territory.
Yeah.
Yep. Okay, that makes sense. And okay, a couple of stock-specific questions for you in the property space in Australia. Lend-Lease has featured heavily in the press this week. They've announced they're exiting the US. That follows hot on the heels of them exiting Asia. And there's further discussion that, in fact, they are putting together something or a plan, an exit plan for their UK exposure.
Yeah.
What's the rationale behind all that? What's going on there? What are your thoughts on
it? A number of large investors in Lend-Lease have been very disappointed with the performance of the stock, the performance primarily of the CEO and the board. And so they've been pushing for some change. And whilst Lend-Lease to date has sort of shied away from selling some of these assets, the decision was taken last week, the week before, to actually jettison offshore investments and just to focus on Australia. And I can understand why that is. Lend-Lease is like an octopus with many tentacles, with businesses all over the place. It's a hodgepodge. It's very difficult to sort of, one part of the business might be up, the rest of the business is down. It's very difficult to maintain and control. So I think getting back to basics, getting back to the Australian exposure, the Australian market, is probably the right way to go. Apparently there's going to be somewhere around $4 billion worth of assets to sell. Get off the balance sheet, get into cash, and bring that money back into Australia.
Do you expect that some of those funds will be paid out to shareholders in terms of a special div, or will they be sort of utilised elsewhere?
I very much doubt it. I think they'll be utilised elsewhere, reduce debt, bolster up some of the domestic businesses. I don't see any immediate payback, other than there might be there should be an improvement in the share price over time, but it's going to be gradual rather than in one big hit.
Okay, and you as a property fund manager, I gather I'm getting the sense that you're positive about these changes that Lend-Lease is making.
Positive about the change, but I'd like to see them actually start and take place before committing.
Okay, understood. One more stock-specific question for you. On the domestic front, there was a large sell-down in Dalrymple Bay Infrastructure.
Yeah.
DBI is a code. On Wednesday night, it looks like QIC sold its shareholding, which is slightly above 10%.
Yeah.
It was done via a book build with Macquarie. It was done at a almost a 7.5% discount to the prevailing price at the time. What's your take on this? What's going on? Why the exit by?
Well, maybe I'm being a bit cynical, but at the same time, a couple of days before, there was an announcement that the Queensland government is actually borrowing some money from QIC, and so that may be one of the reasons why they've sold this block, because they've now got about $129 million out of the transaction. The stock has been performing exceptionally well, got up nearly to $3. And the price that the book build was based on a range between $2.58 and $2.70 in 2-cent increments. So it was actually sold towards the lower end of the price range at $2.62. But it is a very attractive investment. Dalrymple Bay Infrastructure owns the coal loading terminal in Queensland. I think it's one of the biggest in the world. So it's an owner of property, as it were.
Yeah.
And it's doing exceptionally well. They're shipping out record tonnages. Now at $2.62, the stock is actually yielding 8.2%, but it's franked to 67%. So when you take the franking into account, that becomes a yield of 10.5%, which is
pretty
very attractive. It's pretty good.
Pretty impressive. Do you have it in your own portfolio?
Yes, we do have it in our portfolio. But it's settled now at around 276, and at 276, on a cash yield, it's yielding 7.8%, and on a franked up yield, it's yielding 10%, which is still very attractive. So, and I think distributions are likely to grow over the next couple of years.
Okay. All right. Well, that covers the stock specific. Looking forward to next week. Is there anything that that you've got your eye on for next week? Anything we should expect in terms of news flow on the property front?
Well, we're into June next week. Today is the last day of the month. We'll see what happens on the close today. There's always a little bit of manoeuvring here and there with stocks to make them look either a little bit better or a little bit worse for the month. So the stocks, the REITs will start announcing distributions for the June quarter.
Okay.
Starting next week and the week after. So that's one thing to keep an eye on in terms of whether distributions are maintained, whether they're changed, whether they're cut back. I expect them to be maintained because so far we haven't seen a lot of adjustments in terms of what the outlook is from management. So that's one thing to keep an eye on in the next couple of weeks. But it will be the end of the financial year at the end of the month. I expect the REITs to do reasonably well because people will want to hold on to get their distribution, and then we'll see what happens in July.
Okay, great. Well, Winston, thank you very much for your time, as always.
It's a pleasure.
And we will be back with another edition of Winston's Weekly next Friday. Until then, have a great day and a great week.